Okay, so I would like to get into really the keep it simple structure, the bare bones of what our deal is and how it really works, right? So this is the only slide I'm going to go through. It pretty much is all we need because it really is a simple deal. I mean, it's a creative deal, right? So don't get me wrong, it's a very creative deal, but it's a very simple deal and it's super favorable. It's like so well aligned and it's extremely bootstrapper friendly first and foremost, but it's just like so well aligned in the way in which we designed it. We're very proud. Like we have a lot of pride in the way in which we structured this thing. So I'm excited to take you through it and then get your feedback on it. We are always trying to make our things better, of course, right? Always be optimizing. That's one of the things in which we constantly promote. Always be optimizing, right? Because we do have a belief system, right? So the why behind our deal structure. We believe that most organizations have unlocked equity just trapped inside of them, right? We genuinely believe that you could look at pretty much any business and through simple structures, strategies, and most importantly, accountability, but through just like simple playbooks, you can unlock equity. You can, just the same way that when somebody who's, we're so familiar because of all these real estate shows and everything, somebody buys a house and then they go and put in a new kitchen and that adds 100K and a new bathroom adds 50. And then, you're all of a sudden adding $150 of equity into that business, into that home that you can then, sell. And meanwhile, the kitchen only cost you, let's say maybe 20 and the bathroom cost you 10. So you just margined a buck 20 plus cost of capital. Like the same way that it's been so simple for folks to see that with real estate, we see that with businesses, right? Now, there's a lot of folks, we're not unique in this situation. Like private equity is a real thing. It's an industry that's been around for quite a while now. I mean, still relatively new, but still like, fairly mature. It's the idea of buying a business, right? Figuring out how you can improve that business, make it worth more, or unlock equity, right? Captured equity, locked up equity, and then, be able to margin into that wedge. And that's what we define as wedge equity, is the difference between where you start to where you finish and the amount that you're able to capture. That's what we define as wedge equity. So what we believe is that pretty much every business has that. And what we've dedicated ourselves to become the best at, right? Like we want to be like the Michael Jordans of this game. I mean, we really want to be the Michael Jordans of the deal game in general. But realistically, if you were to focus in, our true specialization is to be able to identify and unlock wedge equity or build wedge equity in businesses realistically through simple playbooks. So that's what we do, right? And it's a simple deal structure. And what we would want to do in our structure, the way that it works, is invest a certain amount of money, right? We invest a limited amount of capital. We call it performance capital because the goal is for us to invest and then come in and perform, right? So we aligned it from the beginning, branding, performance capital. So we will invest a certain amount of performance capital. And then after doing so, we'll help you build a set amount, predefined, pre-negotiated, pre-agreed to. Typically, we pre-agree to it because we want to put guarantees, truly like guarantee that we'll do this stuff, depending on the deal structure that we land in, a certain amount of wedge equity in your business. So this could easily look like this. We will invest 10K in your business, performance capital, and then help you build 100K in wedge equity in your business, right? So right there, you're getting a 10X return on the equity from our investment. Again, we're investing this capital. What you then get is 100K in this scenario of equity plus more customers, better profitability, and a simpler life. Because the way that we do this stuff is we implement an operating system. We identify the ways that we could help you get more customers in a more affordable way with less friction that ultimately supports a better experience. Ultimately, that lands with better profitability. And because everything's easier, you end up with an easier business, a simpler business. That means a better life, a simpler life, right? So like we focus on operational efficiencies and effectiveness through implementing an operating system. And then we crank and optimize the revenue engine, right? We really are really good at the growth throttle side. So we get you more customers and more profitability, ultimately more revenue and a better business. And that's how we that's how we unlock all this equity, right? We do these set things. We know what to do that would make your business more of an investable asset and more marketable for investors to come in and either invest in it or buy it, right? And we focus primarily on getting you capital ready, right? More capital from customers, better terms from investors, better valuations for the acquisition. That's what you get. We get paid back blank. In this situation, it was like we would get paid back $10K. That's what our investment was. So we would get paid back our $10,000 over time. Again, it's a performance-based capital investment, meaning we aligned our repayment with the ebb and flow, the up and down, the variability of your revenue. So we take a small percentage, typically 10%, because most businesses can afford that 10% ratio. It's not too heavy on the business to create a burden, especially if we're doing these other things. It's a safe, healthy number. So we take 10% of your revenue in order to get repaid back our investment, right? So if you make more, we get paid back faster. If you make less, you're not paying us more than you can afford, our repayment drops, right? So if you make no money in a month, we get paid nothing, right? So that's how it's super, like I said, super flexible and variability based around the bootstrapper. And this is probably the most bootstrapper friendly approach that somebody could take, right? So that's why we did it like that. Again, like very much so to our core audience. It's who we are. And the goal here is that we want to align around the unlocking of the equity and the mutual why is this last part. So we're getting paid back. That's fair, right? But what we really get out of it is an option to buy or an option to acquire your business for a predetermined amount. So in this situation, I believe I said that we added $100K in equity. So what we would ask is to have the option to buy your business for somewhere in between what it's worth today and an additional $100K. So typically we look for a 50-50 split. We look to split the baby. So in this situation, we would look to purchase it. We would look to get the ability to buy your business for $50K more than what it's worth today. So if you really boil that, super fair, right? So if you really boil this down, we're saying that we will invest $10K to add $100K to your business, right? So that you get $100K more in equity in a better business, right? A much better business, more customers, more profitability, better operating system. We get paid back our $10K through a percentage of your revenue over time. And then we have the ability to purchase your business for $50,000 more than it's worth today, right? And it's an option. It's an option to buy it. So that's our deal structure. Super simple deal. It's like the most founder-friendly, most bootstrapper-friendly deal structure I've ever come across. I mean, we've done it for such an intentional reason. It's great economics at the end of the day, right? Because I'm going to pull back curtain, the catch, right? Because like, what's the catch? What's in it for everybody? The catch is a lot of this initial upfront investment is not capital investment. A lot of it's tied to other ancillary services and goods, materials, things of tangible value that we already have that allows us to kind of pad what the initial upfront investment is, right? So it's typically a set amount of capital, hard capital that we will disperse and invest in your business. And then tied to that is then a percentage of these other line items realistically that tie into the terms of the agreement. That's probably the biggest like catch in a sense, right? Like where's the hair on the deal? There's always some hair on the deal. If it's too good to be true, then it probably is. You know, I'll just call it as it is. That's what it is. That allows us to mitigate the risk. But again, we're doing all of this stuff, right? So we are literally coming in and giving you a ton more value than what we're asking for in exchange. And then all we're asking is to get paid back from a percentage of your revenue, percentage of your upside, percentage of your performance over time, We're not asking for a fixed amount. We're not saying, hey, give it to us up front. We're coming in and doing all this stuff, giving it all to you, and then just saying, hey, I know you're good for it, because we're in it together. And we believe that we're going to get to this additional equity, unlock this additional equity in your business. And when we do, we all win, because we'll be able to come in here and buy your business. You're going to get more than what it's worth today, right? So we're pretty much doing this work. We're pretty much paying ourselves to do the work, right? You're getting more. And then we also then have the ability to now wedge that incremental value. So in that situation, from the work we did, we rehabbed your business, right? We put in the kitchen, we put in the bathroom. Now we get to share in that additional 50K in upside, and then we can acquire your business, right? Or find somebody else who wants to acquire your business, and we could do a deal, right? So again, it's structured for a win-win-win. In no situation should this be a loss. And in every situation is it positioned for upside, and there are guarantees to it, depending upon how we negotiate the terms and how we can underwrite your business, right? So there is an underwriting process. This is just like the structure. I don't want to get too far into the weeds, because there's other videos that we've done on like how we underwrite and what the process looks like and all that stuff. But we're going to connect with your bank account. We're going to, after you've gone through the application processes and we've had all the conversations, we're just going to make sure and validate the information you provided is the right information from your financial institution, that the numbers are right and they make sense. And then if we can underwrite this, we'll structure it with exactly what fill in these blanks are. And then that gets into the performance-based capital. And what we really, call it is our SAFER agreement. So a simple agreement for future exit and revenue repayment, right? Again, very creative, and it's uniquely ours. Very special thing. We're very proud of it. And we would just be able to get this deal done, work together, and then be able to get there. Again, everything is written so that it's super, super, super fair, reasonable. If we can negotiate the terms and underwrite everything appropriately, we put full guarantees. We guarantee we will add X of equity, right? Or we'll continue to work for free until we do, type of thing. We're in it for the right reasons, and it's a deal to be done. There's also optionality for you to get out of the deal. We make it super fair for you to be able to get out of the agreement, right? If it's not a deal you want to do, or you don't want to sell it anymore, right? That comes up. And also in this whole situation, we also have the option to not have to buy the deal as well, which is why it's an option to acquire you at that point. Because maybe we're in the business, we're working in the business, we're doing all this stuff, building up the wedge equity by implementing these systems, right? The operating system, structure, strategies, and accountabilities that get to simple, profitable outcomes. And we just realize, hey, this isn't a deal we want to do. So for all of those reasons, and definitely more, we're very, very proud to be able to offer this to the market, to be able to take this and build up our portfolio, have more portfolio companies come part of our ecosystem, and be able to do something super special, specifically for bootstrappers, specifically for entrepreneurs, but realistically for everyone. We're taking this structure and doing it also in the middle market. It's just, you just add a couple more zeros is ultimately the way that things, bake out. But just want to give you a high level overview. That's what it is. Look forward to your feedback on it, and talk to you soon.